Lesson 5. Comparing life insurance policies. Welcome back. In Lesson 4, we discussed why term life insurance is often the best starting point for families. It is simple, affordable, and designed to protect people during the years the financial risk is greatest. But term insurance is not the only type of life insurance available. You may also hear about whole life, universal life, indexed universal life, and variable life insurance. These policies can sound confusing, especially when they are presented with illustrations, cash values, interest crediting formulas, and investment choices. Today, we will compare them in plain English. Before comparing policy types, begin with one question. What job must this policy perform? Do you need income protection for 20 or 30 years? Do you need coverage that may last for your entire life? Are you providing for a lifelong dependent? Do you need cash for estate or business planning? Or are you mainly interested in building wealth? That last question matters because life insurance is primarily a risk management tool. If your main goal is investing, compare the policy with retirement accounts, brokerage accounts, and other investments. Do not assume that adding cash value automatically makes life insurance a better investment. Term life insurance provides coverage for a stated number of years. It generally has lower initial premiums, a level death benefit, a level premium period, and no cash value. Term insurance is often well suited for temporary needs such as income replacement, raising children, paying a mortgage, education funding, and covering debts during the working years. For many families, term insurance provides the greatest amount of protection for the lowest initial cost. Whole life insurance is designed to provide permanent coverage when the required premiums are paid. It generally includes a guaranteed death benefit, scheduled premiums, guaranteed cash value growth, and possible dividends. Dividends are not normally guaranteed. Whole life premiums are usually much higher than term premiums for the same death benefit. A whole life policy may be useful when someone has a permanent need, such as providing for a lifelong dependent, creating estate liquidity, funding certain business plans, or leaving a guaranteed legacy. But a family should not buy too little protection simply to obtain cash value. Protecting the family comes first. Universal life insurance is also designed for permanent coverage, but it usually provides more flexibility than whole life. The policy may allow changes to premium payments, the death benefit, and the timing of payments. The policy has a cash value account. The insurance company credits interest and deducts policy expenses. This flexibility can be useful, but it also creates risk. If premiums are too low, expenses increase, or interest credits disappoint, the policy may not last as long as expected. A universal life policy should be monitored regularly. Flexible does not mean free. The policy still needs enough funding to support its costs. Indexed universal life, commonly called IUL, is a type of universal life insurance. Its cash value may earn interest based partly on the movement of a market index such as the S&P 500. However, your money is not invested directly in the index. Interest is calculated using a formula that may include a cap, a participation rate, a spread, or other limits. The policy may provide a 0% floor for an index crediting period, but fees and insurance charges can still reduce the policy value. IUL illustrations may show attractive future values, but many of those values are not guaranteed. Ask to see both the guaranteed results and the non-guaranteed illustration. Also, ask what happens if interest credits are lower than illustrated. Variable life and variable universal life policies allow cash value to be placed in investment choices called sub-accounts. These may invest in stocks, bonds, or other securities. The cash value may rise when the investments perform well. It may also fall when they perform poorly. That means the policy owner carries investment risk. Variable policies may also include several layers of costs, such as insurance charges, administrative fees, investment expenses, and possible surrender charges. These policies may offer growth potential, but they are more complex and require ongoing attention. Here is the simplest way to compare the major types. Term life provides temporary protection with no cash value. Whole life provides permanent protection with scheduled premiums and guaranteed cash values. Universal life provides flexible, permanent coverage that must be properly funded. Indexed universal life uses an index-linked formula to calculate possible interest credits. Variable life provides market-based investment choices and direct investment risk. No policy is automatically good or bad. The correct choice depends on the need, the cost, the guarantees, and the risks. When permanent insurance is presented as an investment, compare it with another approach. Purchase enough affordable term insurance. Then save or invest the difference between the term premium and the permanent policy premium. This approach may offer greater flexibility, clearer investment costs, easier access to the money, and a wider range of investment choices. Permanent insurance may still be appropriate for a permanent need. The point is not that one approach always wins. The point is that you should compare both honestly. Now turn to the policy type comparison section of your workbook. For each policy you are considering, record the policy type, the death benefit, the premium, how long the premium is guaranteed, whether the coverage is temporary or permanent, the guaranteed cash value, the non-guaranteed values, the surrender period, the policy charges, and the main reason the policy is being recommended. Then answer one important question. What specific financial problem does this policy solve better than the alternatives? Here is the main message from this lesson. Life insurance should be selected based on the job it needs to perform. For temporary family needs, term insurance is often the strongest starting point. Permanent insurance may serve valid lifetime, estate, business, or special needs goals, but permanent policies usually cost more and require careful review. Understand what is guaranteed, understand what is only illustrated, understand the costs, and never confuse an insurance illustration with a promise. In Lesson 6, we will look at policy ownership, beneficiary choices, and the tax treatment of life insurance proceeds. You are learning how to compare policies based on facts, not sales labels. I'll see you in Lesson 6. Welcome to Robertson CFP. Let us build your future together.